The Phillips curve. The Phillips curve shows the relationship between the inflation rate and the unemployment rate. It was named after a New Zealand economist, William Phillips. Phillips analysed the historical data of the UK over a long period and discovered an inverse relationship between the inflation rate and the unemployment rate. This means that as the inflation rate increases, the unemployment rate decreases and vice versa. From the graph, if the government uses a policy that reduces the unemployment rate from 7% to 4%, the inflation rate will increase from 12% to 18%. This shows that there is a trade-off between inflation and unemployment. A policy that reduces unemployment will fuel inflation. A policy that reduces inflation will increase the unemployment rate. Let us assume the government wants to reduce unemployment by using an expansionary fiscal policy. It will reduce the tax rate. This will increase both consumption and investment. When consumption rises, businesses have to produce more goods to meet people's demand. This will lead to the creation of jobs as workers are required in production. Consequently, the unemployment rate decreases. A reduction of the tax rate makes more profit available for expansion or investment. This also creates jobs. Employed people have more money to spend, which can increase the inflation rate. If there is inflation in an economy, the government can increase the tax rate to reduce consumption and investment. Aggregate demand, as a result, will fall since consumption and investment are components of aggregate demand. Jobs are lost when aggregate demand decreases. An attempt to reduce inflation increases unemployment. This confirms the inverse relationship between the inflation rate and unemployment rate. The relationship suggested by Phillips may not be true in certain circumstances. It is possible for both inflation and unemployment to be rising at the same time. In a period of stagflation, there is no economic growth and the inflation rate is high. Because there is no economic growth, jobs are not created. The inflation rate is high or increasing, but the unemployment rate is not decreasing as shown by a traditional Phillips curve. For example, a rise in crude oil price increases cost of production and reduces supply, causing a rise in prices while unemployment rate rises at the same time or remains the same. Expectation of a rise in the inflation rate makes workers to demand higher wages. This will cause inflation. Producers also raise their prices if they expect the inflation rate to rise to maintain their profit margins. This will increase the inflation rate without reducing the number of workers employed. Expectation of a rise in the inflation rate shifts the Phillips curve upwards, increasing the price level from P1 to P2. But the unemployment rate remains at U1. Supply shock. A sudden rise or fall in supply would shift the Phillips curve downwards or upwards. The discovery of advanced technology would cause an unexpected rise in supply and put downward pressure on prices. It shifts the Phillips curve downwards. The graph shows the effect of technological advancement, a positive supply shock. The Phillips curve shifts downwards. The inflation rate decreases from P1 to P2, but unemployment rate does not rise as indicated by the traditional Phillips curve. In the long run, there is no inverse relationship between the inflation rate and unemployment rate. The Phillips curve is a vertical line, meaning that the unemployment rate remains the same no matter the change in the inflation rate. The unemployment rate reaches the natural rate of unemployment in the long run. This is the unemployment rate that occurs when the economy is at equilibrium or full capacity.